We need to talk about what's really happening in the labor market right now, because the headlines you're seeing about economic growth are telling you one story, but the employment data is screaming something completely different. And if you're not paying attention to these numbers, you're going to be blindsided by what's coming. This week gave us a flood of economic data, and none of it was good when it comes to jobs. But before we dive into the numbers, I want to set the stage with what's happening in the stock market, because it's directly connected to the employment crisis we're about to discuss. There was a massive sell-off in software stocks this week, and it happened for reasons that might seem contradictory at first. But when you zoom out, it tells you everything you need to know about where this economy is headed. The big software-as-a-service companies got absolutely hammered for two main reasons. But here's where it gets interesting. These same AI coding models also appear capable of mimicking popular business platforms, things like Salesforce and similar tools. Now, I think this triggered a bit of an overreaction in the market. There's no question AI is going to increase productivity, but we're light years away from these tools completely replacing established software platforms. Still, the damage was done. The sell-off wiped out about $2 trillion from software stocks, and it didn't stop there. The private credit market also took a beating because many of these shadow banking giants are heavily invested in software companies. Any degradation in that sector creates ripple effects we don't see in the headline numbers.
The other phenomenon that caught everyone's attention was the initial sell-off of the major tech companies, even though they basically beat all their earnings projections. Meta, Alphabet, Amazon, they all announced their quarterly results and they looked great on paper. So why did the stocks drop? It comes down to their capital expenditure announcements. These companies revealed they're planning to spend even more than expected on data centers and AI research in 2026. We're talking about roughly $650 billion combined investment for this year alone. Now, in previous years, these kinds of announcements would boost stock prices because investors loved hearing about AI investments. But suddenly, in 2026, the market seems to have cooled on the idea.
There are two forces at play here, and understanding them is crucial to understanding the labor crisis. The market is starting to realize that our entire economy has become dangerously dependent on the promise of AI, but we haven't actually seen the benefits materialize yet, and that's creating some serious internal tensions, not just on Wall Street, but within the administration itself. Think about this for a second. The government is claiming GDP growth is robust, over 4% in the third quarter, with predictions of close to 5% for Q4. Those are impressive numbers on paper, but there's enough research out there now to tell us that this figure would be close to zero if you stripped out capital expenditures on AI. And even more concerning, the areas where we are seeing growth are actually indicators of an economy in decline. We're seeing growth in healthcare for an aging population, government spending, and stock market returns. Sure, these contribute to GDP, but they don't reflect a healthy, growing economy. So when these massive companies announce they're doubling and tripling down on investments designed to increase productivity, it's starting to cause alarm. Because here's the thing about productivity. It means doing more with less. And in this context, the less is people. It's jobs. It's workers. The market is catching on to this paradox. If the AI race succeeds, it means we need fewer people in the workforce. If it fails, we've just flushed trillions of dollars down the drain. Either way, it's a problem. Now, if you want to grow an economy beyond healthcare, government spending, and stock market gains, you need what economists call the real economy to participate. Things like travel, tourism, manufacturing. These are sectors that contribute to GDP and create real wages. But these areas are struggling badly right now. The dollar is down about 10% since the beginning of this administration. And this isn't accidental. It's a deliberate policy move designed to boost tourism and manufacturing by making American goods and travel cheaper for foreigners. But here's the problem. We lost 70,000 manufacturing jobs in 2025 alone. And according to recent reports, Travel to the United States from outside the country dropped 4.2% last year. That's a $50 billion loss in tourism spending.
Why is this happening? On the manufacturing front, we've talked about this before, but we don't have a coherent industrial policy. The administration's actions are so erratic that nobody wants to invest new capital in anything related to manufacturing. Changes to the tax code have allowed existing manufacturers to invest in upgrading equipment, but nobody wants to build something completely new when the president might start a trade war with an ally, or impose a 100% tariff on a supplier, or just completely reverse course. So despite this weaker dollar, which should theoretically help manufacturing, we can't spur new investment. And even though global tourism was booming last year and our weaker dollar technically made the US more attractive than ever, we ended up as the outlier with a substantial decline in tourism. I know that's a lot to process, but keep all of this in mind as we look at the labor data that just came out, because it all connects. Let me share some insight from one of the most important voices in finance right now. There's a bond trader who manages a $2.5 trillion portfolio of fixed income investments. Now, you might not follow bond traders like you follow stock market analysts, but here's the thing. Bond traders have to follow macroeconomic trends and see the bigger picture. They don't fall for hype, they deal in reality. And this guy is saying something really important. He's pointing out that we haven't really had a jobs day in months because the employment numbers keep coming back negative. The job openings data, the layoff announcements, the unemployment claims, the service sector employment indicators, there's no ambiguity about where we are in the jobs market. We're having a really tough time. He makes this fascinating point. We're watching productivity explode higher. Growth numbers look good, but the job market is struggling badly. The economy is operating incredibly well, but only on a couple of cylinders. Capital expenditures are robust. Consumer spending looks strong. But that consumption is being driven by wealthier, older people with savings. And this is why interest rate policy isn't as effective as it used to be, because that demographic is doing extremely well. The burden is falling on low-income workers, small businesses, and younger people. We've shifted to an economy that's more asset-oriented than labor-oriented, and we have a real problem in terms of needing to employ more people. Here's why this matters. The economy looks fine if all you care about is GDP growth for the sake of growth, capital flowing to capital. But this relentless focus on productivity, on doing more with less, might be good for corporate earnings and stock prices, but it comes directly at the expense of the working class. The administration will argue that if the working class was doing so poorly, consumption would be down. But consumption is up because the upper end of the economy is doing most of the spending. And to the extent that middle and lower classes are participating, it's largely on credit. That's a warning sign, not a sign of health. The administration has defended its working class credentials by pointing to policies like no tax on overtime and no tax on tips. But let's think about what that actually means. The no tax on overtime provision only applies to the premium portion, so it really only covers about a third of overtime pay. And sure, it's better than nothing, but here's the problem. When your entire economic policy revolves around a weak dollar and capital expenditures on AI, that weaker dollar means it buys less, not more. That's inflation, and it disproportionately impacts lower and middle-income earners. And productivity gains from AI investments are designed to reduce the number of hours people work, which is why we're already seeing a decline in hours worked across the economy. And no tax on tips is great if hospitality is booming, but only high-end dining is doing well. Tourism has been decimated. So these policies sound good but don't address the fundamental problem. Labor is the biggest casualty in this economy, and the numbers from this week confirm it beyond any doubt. Let's look at what we know. Starting with the year-end wrap for 2025, the data shows it was the biggest year for layoffs outside of COVID in a decade. And not by a little bit. These numbers are staggering when you consider the slow growth in hiring on the other side. We're talking about massive job losses paired with very little new hiring. Looking at the forward-looking data based on CEO surveys, we're seeing the lowest number of planned hires announced in January going back a decade. We're starting the year in a deep hole compared to prior years, and we'd need to see a significant rebound in the coming months just to get back to average. But that seems unlikely given everything else happening. The headline employment figure for January shows private employers only added 22,000 jobs.
For context, private employers added 771,000 jobs in the previous administration's final year. Last year, that number dropped to 398,000. Now we're at 22,000 for January. But it's where those jobs were added that tells the real story. The results in services are mixed, with professional services getting hammered, but education and healthcare seeing growth. And when you drill into it, healthcare dominates, which is a reflection of an aging population requiring more care. This isn't productive GDP growth. This is demographic necessity. Financial services and utilities are up, driven by the insurance sector and the increased power demand from data centers. Again, these aren't areas you want to see growing in isolation. Manufacturing, on the other hand, is declining. That's the real problem. We also got job openings data from the Department of Labor. For the week ending January 31st, initial unemployment claims increased to 231,000. That's 22,000 over the prior week. But here's the real kicker. The number of job openings trended down by nearly 400,000 in December to just 6.5 million. Year over year, openings are down by almost 1 million jobs. These are stunning numbers that confirm what everyone who's paying attention already knows. The labor market is contracting. And even good news is bad news when the good news is increased productivity, because that just means more layoffs are coming. And that's exactly what we got in the updated layoff forecast. U.S. employers announced 108,000 job cuts in January. That's a 118% increase from last January, and it's up 200% over December. One particularly egregious example this week was a major media company laying off its entire sports department and most of its overseas journalists. About 300 jobs eliminated from a single news organization. And while 300 jobs is significant, it's just a drop in the bucket compared to the overall trend we're seeing. So what's the big takeaway from all of this? The economy, in the eyes of the administration and the investor class, looks okay if you measure it purely by capital flows. That gives the appearance of continuity, maybe even health. But this masks the underlying crisis that threatens the whole system. You can't build a sustainable economy on capital flows alone. You can't point to healthcare as your labor market victory when it's just a reflection of an aging population needing medical care. Words and actions matter. People don't want to build new manufacturing in a country with no industrial policy, an unpredictable government, lack of subsidies for startups, and no long-term vision. People don't want to travel to a country that's become hostile and unpredictable, no matter how attractive the exchange rate is. No tax on tips and overtime doesn't help when you're getting fewer tips and your overtime hours are being cut. This is the reality of the labor market right now. The numbers don't lie, even when the headlines try to paint a different picture. We're watching a slow-motion crisis unfold, and most people won't realize what's happening until it directly impacts them. The question is whether you're going to prepare for what's coming or wait until it's too late.